the week ahead. Let's start by talking about last weekend. One of the things that caught my attention is in the week ahead comments, there were one person was looking for a V-shaped recovery. Another was looking for, a gap higher on Monday. We did get the gap higher on Monday. It didn't hold throughout the week. But I think what is important, and where did those comments come from? Those comments, more than likely, came from people that were simply looking at price, where they're treating price momentum as the only factor. More than likely, what was going on with the upward price momentum was some very serious short covering. A huge mistake that traders often make is mistaking short covering for new money buying. Short covering is actually old business, and old business or short covering can actually contribute to weakening the market. When inventory gets too short, it provides short-term support for the market because you have to buy in order to cover. If you don't recognize the potential for the rally to be only short covering, you're going to very often get misled and expect to see the market going sharply higher. So many times, focusing only on price momentum is a huge trap. What we have been saying about why you integrate the market profile or market generated information with traditional price momentum. And as you remember, we still say that price momentum is the leading indicator, but market profile or market generated information is the lagging indicator. The reason I say lagging, the price momentum gives you one factor. When you add in the market generated information, you have a better opportunity to determine if the action was new business or old business, or maybe a combination of old business and new business. It is extremely important to make that distinction if you're not going to get misled. When you had a very steep decline, such as we had, more often than not, the market takes time or needs time to come into short-term balance. Once the market establishes that short-term balance, which is nothing more than a way to get inventory rebalanced, then we get another look to see, coming out of that balance, does the market go back up in this case, or does the market continue lower? Next, we're going to look at Thursday's profile. And if we look at Thursday's profile, we will see that Thursday was a classic inside balancing day. You see, it took place entirely within Wednesday's range. And of course, the inside day is a very, very identifiable form of balance. When you examine Thursday and you start to learn how to look at the market, it is another way to distinguish price and put some perspective on price. To make that point, look at the F period low. The F period low took place at the settle. So that exactness, when I see that exactness, that tells me that the odds are very high that the buyers are day time frame or very short-term weak hands buyers. And it tells me that the odds are very high that we will come back through that price before the day is over. As you will see, the market rallied from there, Next, look at the GH and I lows, and notice that the GH and I lows are at the open. If you look at the green dot to the left of the arrow, the GHI, that's the open. Short-term traders were again using a mechanical reference, the opening price, to buy, and they did that in GH and I period. So what was happening? Weaker hands or short-term traders were continuing to get longer in that market. The risk of a late break was increasing substantially. If you don't know how to read the market, and that's the advantage of understanding market generated information and understanding market profile, you think the market was strong. When I look at a day like today and I see where the buying came from, it strongly suggests to me that the buying was weak hands, very short-term traders. I see no evidence that the longer time frame had any interest in today. And you see exactly what happened as we got in late into the session, and those traders, those weak hand traders, got no follow through. They had to liquidate, and most of those traders would have ended up taking a loss. So again, that's part of the information that we talk about when we have the primer or when we talk about short-term inventory, or how do we put context around price. As we go into the long weekend, the market is in balance, at least on a short-term basis. We apply the balanced trading guidelines to next week. The balanced trading guidelines are from the inside day. If you remain within the range of the inside day, it just further tightens the balance. An upside breakout would be the next thing we would look at. So you go with an upside breakout, or you fade or go against an upside breakout that fails. In other words, it breaks to the upside, but it doesn't hold and it comes back in. If it comes back in, that increases the odds that the market will trade to the opposite extreme. Next, go with the breakout to the downside. If the market breaks to the downside, go with that trade. And again, if it fails to carry through and comes back into Thursday's range, then the odds are that the market can rally back up towards the high of Thursday. Now, none of that is absolute and things can change. But when you prepare for the week ahead, if you look at and understand that Thursday was a balancing day, it helps you have a better perspective and not be overly, biased to the upside or the downside. Take a good look at what we've talked about. This is important information if you are going to have a fighting chance to defeat this market. Currently, the trend is down and coming into short-term balance. From that short-term balance, we may see continuation to the downside, or maybe we see a reversal. But this is a very important area once you have started to establish short-term balance. For those that are interested, the primer starts next Wednesday. Have a great week and enjoy Easter. Bye now.